Welcome to Yahoo Finance Live. I'm Shauna Smith along with Akiko Fujita. Let's get you up to speed on the market action. Happy Friday here as we count down the final hour of the trading week. You're looking at gains across the board for the day and also for the week. All three of the major averages trading higher for this week. Tech giants paring back some of the earlier gains. We're really in what seems to be pretty much a holding pattern right now ahead of the Fed meeting next week. Investors looking ahead to what the central bank is going to do next on rates. Consumer discretionary and technology, the leaders in today's action. Let's start off with, though, some breaking news. The indictment of former President Donald Trump has been unsealed. Yahoo Finance's Jennifer Schomburger is here with the details. Jennifer.
Shauna, federal prosecutors unsealing an indictment outlining 37 charges against former President Donald Trump for mishandling classified documents after leaving office and then blocking the government's attempts to try to recover those documents. Included in the 49-page indictment, Trump is accused of breaking 7 laws, including 31 counts of willful retention of national defense information, counts of false statements and representations, conspiracy to obstruct justice, and withholding a document or record. The indictment says information Trump took with him when he left the White House included, quote, information regarding defense and weapons capabilities of both the U.S. and foreign countries, U.S. nuclear programs, and potential vulnerabilities of the U.S. and its allies to military attack. Also highlighted in that indictment 2 instances in which Trump allegedly shared classified information with people not allowed to receive it. Apparently, in July 2021, at his golf club in New Jersey, he told a writer, publisher, and 2 staff members about a secret attack plan. Weeks later, he showed an associate a classified map related to a military operation and told the person who was a representative of his political action committee that he shouldn't have been showing it to that person. Trump is scheduled to appear in a court in Miami on Tuesday at 3:30 in the afternoon. The case Tuesday is being overseen initially by a federal judge, Eileen Cannon, who Trump himself appointed. She has been criticized for handing him a series of favorable rulings. The former president may be asked to enter a formal plea. Trump told Fox News last night that he intends to plead not guilty. We are awaiting a statement now from Jack Smith, the special counsel who is bringing that case, to make a brief statement to the media. Back to you.
And the first remarks we'll hear from Jack Smith on this indictment. Jennifer Schomburger, thanks.
Well, let's talk about what comes next for the former president, as federal prosecutors have now unsealed some of those charges there. Let's bring in James Carville, political strategist and host of Politics War Room. James, you heard Jen there sort of laying things out. 37 counts, including charges of willful retention of national defense information. Put this in historical context for us.
Well, I really don't have much of a, I mean, it's sort of breathtaking in one sense. But if you do what I do and spend your time listening to Fox and right-wing radio, you would think this was the equivalent of a failure to yield a right-of-way violation. I'm more interested in the political ramifications of this. And it seems to me that any Republican who veers into thinking that this is a serious issue that compromises national security is not going to fare very well among other Republicans. And I think that's one of the more interesting aspects of this case. The politics of it are going to be just stupendous to watch.
James, talking about those political potential ramifications there, ahead of these charges, Donald Trump was viewed as the leading contender for the GOP nomination for 2024. Does this change that at all?
Yeah, I wish I knew what the Dow was going to do a month from now. It looks like the initial reaction is to rally around the flag, clearly among Republican commentators, among right-wing elites. There are some people that are even suggesting that other people shouldn't run against Trump for the Republican nomination. That seems to me to be quite extreme. I don't think Chris Christie is going to listen to that, but there's going to be a backlash, and they're going to have to answer the question everywhere they go: will you pardon Trump? That's going to be that is the number one question that Republican presidential candidates are going to have to answer from now going forward. And I really don't see this. I don't know if it's going to change. If some Republican voters will be upset about it. 37 counts, according to people who know something about this, these are pretty specific and pretty substantial allegations that are being made. But I'll leave that judgment to others. But for the politics of it, it's going to be a fascinating ride.
Well, and we've already had a number of GOP presidential candidates who've essentially sort of suggested that he will be pardoned if, in fact, he is found guilty on these charges. I mean, does that tell you the hold he still has on the party? And does that essentially answer that question you just asked, which is, will this even make a dent in his support within the party?
Well, it's certainly not going to make a dent with his hardcore support if that's 45% of the party. But the Republicans can't win without the hardcore Trump people. And they will demand, and I suspect they will get pledges from all of the major Republicans that they'll pardon Trump. Now, if these facts come out, they're going to be very difficult. But if you listen to right-wing radio and Fox News, which I do, and by the way, most of my friends who are substantial in this business are listening to Fox and right-wing radio, you hear more talk about the Biden crime family and Hillary's emails than you do about, showing people national security secrets. So it's going to be fascinating going forward here, I promise you. And and these things can develop. I would say I think one of the most important events coming up is the trial that Trump is facing. We're forgetting about this in Manhattan in March of 2024. That's being sort of sloughed off and lost in the shuffle here. But if there's a guilty verdict there, that could change equations. By the same token, if he's found not guilty in a Manhattan jury, that would change equations the other way. But I think that event is kind of being underplayed in the national media in terms of its certainly political significance and maybe even legal significance.
James, when it comes to the political significance of this, what about the fallout beyond the presidential race when it comes to the GOP in the House and in the Senate, with all the focus here, much of the focus on these cases that Trump is facing and not on the Democratic rival, the runner that he or one of his GOP runners will end up going up against?
Well, that's a very relevant and a very smart question, because if you're running for the county commission, I'm here in solid red Shenandoah County, Virginia, you're going to be asked about this. This is going to be a litmus test. But if you're running for the Senate, or if you're running for the House, it's really going to be front and center. But I don't think there's a Republican candidate in a primary or even a general election that's going to be able to escape this question. And to a large part of the Republican Party, this is some kind of view that this is somewhat treasonous or whatever. I mean, people should really listen to the language. There's a particularly stupid congressman from Louisiana by the name of Clay Higgins, who was actually sanctioned by the Annie Frank Foundation, who put out a very coded, very public insurrection. And it's been very well reported. And, yes, he is on definitely the stupid side of these people, but who knows? Maybe some people dumber than him. I hadn't met him, but it could be. And this is the kind of reaction that you're getting.
James, since we last spoke to you, the GOP presidential candidates, the number of candidates have gotten a lot more crowded. You mentioned Chris Christie as one name that has put his hat into the ring. But I mean, to your point, this is going to be a very tricky message they have to take to voters, sort of on the one hand saying I as a candidate offer an alternative to what's in the White House right now, but also can be different from President Trump. I mean, you've had a chance to listen to some of the messaging that's been coming out. Who do you think, as it stands right now, is best positioned to navigate that?
Well, I'm not sure that the Republican Party wants someone different than Donald Trump. I'm kind of halfway confident they want him or somebody who expresses his resentments and grievances. So I mean, there's some people in, the Republican Party say, well, I like his policies, but I wish he wouldn't tweet so much. I mean, stupid as you can get. But I'm not sure that this event doesn't harden and calcify the people that don't want to change from Donald Trump. There are a lot of Republicans that are not looking for something different. And the more that these potential candidates say they're going to be different than Trump, I'm not sure that's a winning way to win Republican primaries. But it's a sticky wicket out there if you're a Republican candidate of any kind.
So if you're Nikki Haley, you're Chris Christie, you're Ron DeSantis, how do you handle this? Do you just stay away from the former president's legal troubles and just put your message forward?
You can try to stay away from it. You can try to pivot. You can try to change the subject. But the Republican voters are not going to let you. You can say, let's talk about inflation. Let's talk about anything that you want. But the most important thing, I think, to a Republican primary voters is to protect and promote Donald Trump. And these people poll, and they know that. And you see you see some elite right-wing commentary saying, oh, it's time to move on from Trump and that kind of stuff. But I'm not sure that's where the Republican primary voter is, to be clear. And the other thing that my whole world is really looking at, and I suspect yours and other people, is the polling 10 days from now. 7 to 10 days. And I think, we got to let everything digest here. But I can't wait to see the first July poll that comes out. It'll probably before that. It's going to be fascinating, interesting, and it's going to generate a lot of interest and a lot of conversation.
It's certainly going to be interesting to see how this plays. Political strategist James Carville, as always, appreciate you hopping on the show today.
Thank you. You do a good job. Thank you very much.
Well, markets on track to end the week in the green. The S&P holding on to bull market territory after rallying 20% off its October low. Tech giants have been leading the rally over the last several months since the start of the year, but can it last? We want to bring in Ryan Dietrich, the Carson Group's chief market strategist. Ryan, it's good to see you. Lots of investors out there wondering whether or not this momentum to the upside, if this rally has enough legs to continue. What do you think?
Yeah, thanks for having me, and TGIF, everybody. We think it does, right? I've been coming on for a while saying we think this is a new bull market. I know now up 20, everyone's saying it's a new bull market. We went overweight stocks in late December on the Carson Investment Research team, laying out some of these things. I'll just start with this. I love this little factoid. Today's a Friday, right? This is one of the strongest years ever for stocks on a Friday. Think about the last couple of Fridays. We've had buyers. I know we'll see where we close here, but it looked like another up Friday. Keep this simple. This would be the best year ever for stocks on a Friday. Some of the other years, guys, that had good Fridays, 99, 98, 2013, 2017, 2019, 75, 1958. You get the picture. Good bull markets have strength on a Friday because people are willing to hold over the weekend. That's wildly different to what we've seen, obviously, last year in bear markets. So that's one thing that says, you know what, this bull market very well could continue because people are buying on a Friday.
And how much of that, well, it's a very optimistic view here, but how much of that enthusiasm that you have is really contingent on the Fed pausing?
Mm-hmm. Not a lot of it, honestly. I mean, since the Fed started hiking 500 basis points since I think it was March 16th, I believe, last year is the first Fed rate hike. Might have been the 14th. Close enough for government work. The stocks are up. Okay, now I know we had a bear market, and I know we've bounced since then. We think we're very close. Our personal opinion is the Fed indeed is done hiking. The inflation data is coming back. The supply chain's opening up. We don't think they need to hike again, but they're close. But, again, when you look at, let's say the Fed is done hiking, okay? Look at the last 10 times. 1 year later, stocks were higher, 8 of them. Only 1981 and then again in 2001, I believe is when it was, when the Fed stopped hiking and stocks were down a year later. So it's rare. Where you got to worry is when the Fed starts cutting. We don't think we're anywhere close to cuts. I think they're done. And again, the economy's strong. We did all that stuff. I mean, last week's jobs number obviously opened the door to more broad-based strength. I know a lot of people have talked about that. We've been overweight small caps for a while. We think the realization there is no recession coming this year. The realization of that makes small caps and cyclicals look really good. And the theme of the second half of this year, we think, will be more broader based strength, not just tech and communications.
Ryan, we'll get to that in just a second. But going back to what you just said about the Fed, you don't think the Fed is anywhere near cutting rates before the end of the year. How much longer? What's the timeline that you see for the Fed holding rates higher where they potentially are today, or if they raise another 25 basis points next week?
Yeah, I mean, we think, let's not forget it. There's some look at the guest before me. That was a really good conversation, by the way. I'm not going to be nearly as controversial as he was, but I saw he had LSU. I'm an Ohio State fan, so there's a little bit of that there. But nonetheless, we think, the Fed will probably keep things where they are the rest of this year. I mean, it is an election year coming up. Yes, things aren't perfect when you look at some of the inflation data, but the truth, again, wages are coming down. The rents have been coming down significantly. The economy is still strong. We just think they're probably going to leave things where they are for at least the remainder of this year, in our opinion.
So let's talk about where the focus is in terms of your investments. The focus for markets has been tech. You mentioned it, the major AI-driven rally, but you say industrials are a good bet for the rest of the year. Walk me through your thesis.
Yeah, we think so. I mean, tech's obviously doing great. Communications. We know they had a rough year last year, so they bounced back. But now what we've seen with a lot of this economic data just recently, the realization there's no impending world-ending recession that we've been hearing about for 15 months. We haven't been in that camp at all. We were in the very quiet camp. There'd be no recession this year because the consumer is just too strong for a recession to happen. Sure, housing's been in trouble. Manufacturing's been in trouble. We think we're getting through that. Now back to industrials. We like industrials as small caps. I'll focus on industrials, though. Just look at this recent earnings season. Industrials did really well. A lot of big industrial companies had positive things to say about the future, increasing their earnings guidance for 2023. Valuations are solid. And honestly, when you look at industrials versus like the Russell, 1000, the R squared is very high. What I'm getting at, industrials tend to move with the market. The market probably has been stronger than industrials lately. We think industrials play catch up here again with the realization that there's no recession and things broaden out. And small caps also, we have an overweight to small caps relative to large caps. We think that's another area that should do pretty well the second half of this year.
Ryan, there's been some focus on the FOMO trade, fear of missing out. That's what's luring traders, luring investors back into the market. How big of a driver do you see the FOMO-driven trade being at this point in the rally?
Yeah, it could be a very big point. I mean, that's a great point, right? We just saw yesterday the AAII sentiment poll, huge jump in bulls. Where finally people looking around saying, oh, okay, maybe it's safe to dip our toe in. From a contrarian point of view, sure, we could have some type of peak. But I'll just say this. I created something called the Carson Composite. It looks at your average year, your average third year of a presidential cycle, your average third year of a new president. What happens when you have a 5% gain in January and you smush all that up? What's that year look like? More strength in June and July with an August peak, and then that seasonal fall weakness, which we wouldn't be surprised at all. So I think my base case is still a surprise summer rally. Then people get a little too excited, and then the fall, they get smacked a little bit, and that's how it works. But we're still bullish, and we'd absolutely be buying some fall-time weakness for continued higher prices.
Yeah, I mean, it also sounds like your argument being that things aren't going to be so concentrated as they are right now in tech. We are going to see the rally broaden out. With that said, we have heard over and over about that AI trade. Are you buying into that right now, or do you see so many other opportunities where you think that maybe AI isn't the play because things have gotten a little frothy?
Yeah, we think a little frothy with the AI. Wouldn't it be something if tech took a little bit of a break when all this excitement took place? I mean, look at like even weight S&P 500, even weight Nasdaq 100. We're starting to see outperformance there. We get it. Everyone said the 5 stocks were leading for the longest time. That's not been the case recently. So things are broadening out, and that's a positive. And again, doesn't mean tech has to go down. Tech can probably still go up, honestly, the rest of this year. We just think there's probably some areas that probably do a little bit better as that baton. Let me put it like this. The lifeblood of a bull market is kind of passing the baton back and forth, right? Tech took it in a big way recently. We think they're going to pass it around and let some of the cyclicals take the leadership the second half of this year.
Ryan Dietrich, Carson Group's Chief Market Strategist. You said it, TGIF. Good to have you on today.
Yes. Thank you. Appreciate it. Goodbye.
We are just getting started here on Yahoo Finance Live. Coming up, Affirm founder and CEO Max Levchin joins the show to discuss the company's partnership with Amazon. Plus, Netflix seeing a subscriber boost amid its password crackdown. We're going to break down the latest from the streaming giant. And more good news for Tesla. Shares on track for their 11th straight day of gains. We've got details on the other side. We'll be right back. Crypto exchange Binance has indefinitely paused all American deposits and given customers until Tuesday to withdraw any dollars. That comes on the heels of the SEC's lawsuit against the company and its founder. Yahoo Finance's David Hollerith has been following the story for us. David, I'm looking at some of the price action today in largest crypto assets. Not a whole lot of swings here, but it's got to make a lot of users a little nervous right now.
Right. Yeah, Akiko, this move by Binance US, one way to interpret it is it's a signal that its banking partners have dropped the company. The company said they're moving to be a crypto-only exchange. In the latest in the case, the SEC is undergoing with them has a hearing set for Monday afternoon, and in it, a judge is going to weigh whether or not to take the SEC's motion to place a restraining order on Binance US's assets, and as part of that, it also means preserving the documents that are internal documents that are part of Binance and Binance US. So we'll wait to see that, but that's obviously a bit of a bigger deal. And when you see these banking partners cut off a company like that, it obviously severely limits liquidity. For Coinbase, it's nothing quite as pressing in the case right now. It's a little bit slower moving just in terms of the first week. CEO Armstrong did say on Wednesday that it's business as usual. But it's still worth pointing out that Moody's changed their outlook for Coinbase yesterday afternoon. And they were citing essentially uncertainty. And for the two companies, crypto's two largest companies, uncertainty is like the main thing that everyone is concerned about. The Binance case has several more issues. But I think in general, it just kind of hangs a worse backdrop in terms of what it means for U.S. investors in the space. But that being said, people have pointed out that Coinbase is, in a scenario where they could present arguments that, they have a potential chance. With Binance, it looks a little bit more dicey. All this to say, though, that we have been paying attention to the net flows or net transfers going in and out of both companies or both exchanges. And those have slowed. They've tapered off in the last 24 hours. And for the last 7 days, so what we can assume is like the whole 7-day period since the lawsuits came out, Binance and Coinbase both look fairly sound in terms of what the outflows are. And the reason why we look at this is obviously with FTX, after bad news happened in November and people started to question FTX's balance sheet, we started to see sort of a crypto bank run. And we've definitely seen higher outflows, 2.4 billion in net flows for Binance and 1.9 billion in net flows, both negative numbers for Coinbase in the last 7 days. So those are still large numbers, but it's nothing like we've seen FTX. So at least in the short term, it seems like investors are not as panicked here. In the long term, obviously, huge backdrop of uncertainty in terms of what's going to happen with these lawsuits the SEC has filed.
Yeah, uncertainty is still the big word within the space. David Hollerith, as always, appreciate that time.
Tesla shares higher after GM followed in Ford's footsteps with plans to use the EV maker's charging network. The stock extending recent gains, up another 4% today, on track to close higher for the 11th trading day in a row. For more on what this means for Tesla and the broader EV market, we want to bring in Colin Rush, Oppenheimer Senior Research Analyst. Colin, it's good to see you here. So what does this mean for Tesla? Has Tesla won the EV charging wars?
I don't know if there's an EV charging war. What they're trying to do is facilitate EV adoption. And a couple things are happening with this is one, you're getting a standardization on plugs. It's just going to simplify, manufacturing for those connectors across the industry. We think that's a net positive and a savings for everyone across the industry. Secondly, we don't need a million networks of charging. And so Tesla's already built out a fairly effective fast charging network, but that's not necessarily going to be the bulk of how charging happens. Most of the charging actually happens at home or at work, where most of these cars sit idle, and it's really a top-up market. And so you've got some fast charging that'll happen, but the bulk of the charging actually happens with level 1 and level 2 chargers. And so, the stock that we cover, ChargePoint, is sold off today, and we think that's going to ultimately be a net winner. It's a buying opportunity right here on some confusion around how the usage patterns are really changing for vehicles as we move towards EVs.
Yeah, Colin, I'm glad you brought that up, because it was interesting to see the reaction to ChargePoint as well as EVgo, some of these other charging companies. You sort of wonder, well, you need all of these chargers to really get the EV adoption going. I want to point to a conversation we had with ChargePoint CEO Pasquale Romano earlier in the week when he asked him specifically about the Tesla-Ford partnership. Take a listen to what he had to say.
We don't want our customers to have to assign our business customers to have to assign a particular parking space to a connector type, because you'll never get that mix right, and that mix will change over time. You want to make sure that any car can park in any parking space and use the charger, because that's just what's simple for consumers. That's just what consumers want. So we're looking to innovate there to make sure that we can adequately support both standards and potentially even go beyond the consumer having to carry that adapter in their car.
So that came on Monday, sort of already hinting at that they are looking at the NACS offering as well. When you look at how ChargePoint has moved down more than 10%, is it a little overdone, number one? And is there a bit of a misunderstanding here? I mean, could ChargePoint also be a big winner on the back of this?
I think both of the answers, or the answer to both those questions is yes. Certainly this is overdone. I think folks misunderstand what's actually at stake here. Charging in the EV world is really an amenity, particularly in public charging. It's not necessarily where most of the charging happens. And so when you look at retailers or multifamily homes, the charging actually is an add-on. It's cheaper than a cup of coffee for folks at work, and you're providing coffee for your employees. It's one of the cheapest forms of advertising and marketing for retailers, and so for us, I don't see there being a slowdown in terms of charging infrastructure that gets built out. And ChargePoint is really well positioned with the back end software. They're really the only company that has fully integrated software with their chargers and the accounting systems and operating systems in the market for their customers. And so for me, I think it's a huge opportunity for them as you start to look at standardization. The companies that can actually provide the full suite of solutions across their platform are really going to benefit from this. And Tesla's really only concerned with facilitating adoption, and so they're not going to go after charging as a key market for the company. It's really part of their strategy around enabling EVs and helping drive the cost of EVs lower. And so I think ChargePoint ends up being the specialist in this space that really ultimately wins a lot of market share and a lot of value capture over time.
Let me pick up on that point. I mean, what is the calculation for Tesla? First it was Ford, now it's GM. They aren't just doing this out of the goodness of their heart, right? I mean, there's got to be a business case here. What is it?
I think this is really more coming from Ford and GM. At this point, when they look at the number of variables that they have to solve to move through this technology transition, providing charging and enabling charging for their customers is one of the key ones it's actually quite expensive. Tesla's invested an awful lot of money, billions of dollars, in building out this network, and for them, they're just providing service and renting out that asset. And so for them, it's it has been part of a customer service offering that they recently started charging new customers for. Initially it was a free service for customers, and now they're starting to charge some of their competitors for it. And so it's a profit pool for the company on some sunk cost. So for Tesla, I think it's just monetizing an asset that they have, and for these other OEMs, it's a realization that they can simplify their lives and really focus on some of the challenges that they have ahead in terms of moving through the transition towards building EVs, which is actually much more difficult than I think most of these OEMs ever really anticipated.
Colin, how much more revenue do you think Tesla is going to generate as a result of these partnerships here with GM and Ford? And to that point, now they have partnerships with their superchargers. There has been some talk from Musk just about licensing their self-driving technology. Is that a move that you think makes sense?
what we've seen the company do in the past is really offer up some of the non-cutting edge technology for competition, whether it's battery technology or otherwise. And so I think it helps some of those competitors move through some of the early stages of commercialization, but it really doesn't change Tesla's technology lead to a real material extent. From a revenue standpoint, we don't have much detail on what's going to really these deals will amount to. At the end of the day, the real driver for Tesla right now is selling cars and then upselling services and features on those vehicles over time. And that's the real thrust here for us, is that it's going to enable more adoption of EVs, and Tesla's in a great position from a product perspective and a cost perspective to really take share in the market. And as we see some of the supply chain simplify, it makes things easier for them as the largest buyer of a lot of these components to continue driving costs down and continue to maintain their advantage versus peers.
What does this ultimately mean for Tesla's competitors in the EV space, whether that is somebody like a Rivian or somebody like Volkswagen that is not using NICS right now? Are they going to be forced to change as well?
It's a little unclear, that the electrical industry has not provided a standard yet for the industry. Is a little curious. That sort of thing typically happens early on in a new market. And, it's taken, the standard setters longer than we would have anticipated to come to a conclusion on that. For some of these other folks, it's an adapter that they need to put on their customers are going to have to use. So it's, a nominal cost. It's not a big deal, but it is a level of convenience per Pasquale's comments earlier that consumers would like to make this easier, and they certainly folks are trying to work in that direction. But I don't think it's a real meaningful change for any of the competition as we move towards standards.
All right, Oppenheimer senior research analyst Colin Rush, thanks so much. Have a good weekend.
Thanks for having me.
Well, coming up, we will check in on a few stock picks to add and a few to avoid when it comes to positioning your portfolio. We've got those for you. Stick around. Netflix shares seeing a boost today after new data shows that its crackdown on password sharing seems to be paying off. Yahoo Finance's Alexandra Canal is here with the details on that. Ali, how big of a win is it here for Netflix?
I think it's a really big win, and there's continued positive data that we've been getting on the ad-supported tier. Now we have new data about the crackdown on password sharing. Antenna is an analytics platform, and they said that U.S. signups for Netflix jumped by the most in at least 4.5 years following the rollout of that password sharing crackdown in the U.S. and over 100 other countries and territories on May 23rd. According to the data, Netflix saw nearly 100,000 daily signups on both May 26th and May 27th. So just a few days after that U.S. implementation. Now, I'm sure with that has come some churn, but I know anecdotally, I've become so used to freeloading on my parents' Netflix account that I can't imagine a world where I don't have Netflix, so I will be one of those users signing up for my own account. I know there's others that say they won't, but I do think the numbers and the data we get surrounding this is going to be very interesting, especially in the next few weeks and the next few quarters. JP Morgan estimating that roughly 100 million users are currently sharing passwords. That's something that Netflix has said as well. But out of those users, the company will monetize 14 million by the end of 2023, 26 million by the end of 2024, and 33 million by the end of 2025. And as you can see, that's leading to a lot of bullish sentiment on Wall Street. JPM boosted its price target on the stock earlier this week, along with Wells Fargo. We also got a new note from Pivotal Research, again increasing that price target to the highest that we've seen on Wall Street, $535 a share, up from its previous $425 target. And if you take a look at where Netflix shares are trading right now, roughly 420, that represents more than 25% upside. So there's a lot of reasons to be bullish here, at least from this analyst perspective, and a large part of that is this crackdown on password sharing, along with the ad-supported tier, which rolled out in November.
Yeah, certainly. Well, we're seeing a lot of excitement reflected in shares today. I think also the question here is what exactly these new users or users that are finally having their own accounts, what they're signing up for. Do we have any idea just in terms of whether or not they're opting for that ad tier versus paying the higher prices and not viewing ads?
Yeah, this data didn't specifically say whether it's for premium tier or the ad supported. I'm hoping that's something that Netflix can dive into a little more when we get their earnings call, because I do think it's important to get a little bit more color around the ad tier since we haven't heard too much specifically from the company. We know that there's been third-party data out there that shows positive momentum, but I do think investors need a little more clarity on the exact numbers.
You also wonder how much of these gains are a one-off. I mean, if you had an account with 8 people on it, sure, you're going to get those to sign up, right?
Yeah.
Exactly. Is it a singular family? Is it people, just wanting to explore it? So I think that's something, you got to take the data with a grain of salt. In the context of everything, I think it's a good thing, at least that we're getting some preliminary results from this.
Hopefully we'll hear more from Netflix on its next earnings call in just a few months. All right, Ali Canal, thanks.
Well, the S&P 500 exiting the bear market territory, driven largely by tech. One of the top performers in the sector, of course, is NVIDIA. The chip giant up more than 150% so far this year. Our next guest says the stock is overvalued after this run. Joining us now is Morningstar Chief U.S. Equity Strategist David Sequeira. David, you're certainly in the minority among some of the analysts that we've spoken to who said there's still more upside with NVIDIA. I'm curious to get your take on where NVIDIA trades at right now, because there is the argument, and I'm sure you've heard it, that things are a little cheaper actually when you think about the outlook for NVIDIA and the upside that we see.
So right now we rate NVIDIA with 2 stars, which means that we think it's overvalued. It's currently at about a 30% premium above our $300 fair value estimate. And again, we have a very positive outlook on the company. It's just a matter of we think that the valuation has just gotten ahead of itself, at this point in time. And when I look at our projections, I don't think that we're necessarily being especially conservative. We are looking for a 50% increase in the top line this year. And in fact, when I look over the course of the next 5 years, we're projecting revenue to grow at a compound annual growth rate of 23%. So essentially taking it from $27 billion in revenue, in 2023 to $76 billion in 2028. At the same point in time, we're also bringing our operating margins up, essentially doubling them to about 50%. Over the past 5 years, they've averaged 28.7. So essentially, we're taking our EPS growth rate, from $3.34 in 2023 all the way up to $16.29. Essentially, people are paying 23.6 times 2028 earnings right now. So again, while we're very positive on the underlying fundamentals, I think it's just the valuation has just gotten ahead of itself.
David, do you also think that more broadly, when it comes to so many of these names that are associated with AI, this AI-fueled rally, is that overdone across the board, or is this more specific to NVIDIA's massive run-up that we've seen?
Well, in this case, I do think it is very specific, to NVIDIA. We do still see some other opportunities out there for investors. Taiwan Semi would be one that I would highlight that I think is good for people to take a look at. We do still think that there's, additional upside there. But, I do think that we're going to see a lot more competition, in this space. They're just generating too much revenue growth, too high a margins. Granted, they do have first mover advantage right now, but with those kind of margins, it's just going to be attracting more and more competition over the next couple of years, and competition not just from the other chip makers, but also from some of the users. So Microsoft, Alphabet, Amazon, all moving into this space, trying to design their own chips as well.
Let's talk about another sector that you're watching that you may not like as much, and we're talking about the energy sector. Obviously, the biggest winner last year certainly hasn't performed to the level that we saw in 2022. Hess is one that you've highlighted. Why?
Well, it's almost a similar story in that, we're very positive on the underlying company and the fundamentals, but we do think that the valuation has just gotten ahead of itself. So we rate this company or the stock with just 1 star. It trades at a 60% premium over our $84 fair value estimates. Company does have, some of the best assets in the space, great growth prospects, but the valuation has just gotten ahead of itself too much. So I talked to our energy analyst, and some of the metrics he was looking at, enterprise value to EBITDA. The stock's trading, above 9 times right now. The next closest competitor is about 6 times. So our fair value estimate would actually still put, a higher valuation on the company at 7 times, but certainly lower than where it's in the marketplace today. And I'd also note too that, we do think oil prices will remain relatively high over the next year or two. We're looking for oil at $72 a barrel on average this year, dropping then to $66 a barrel next year. But when we look at our long-term supply and demand forecast in conjunction with, the cost of production, we do think over time that, oil prices will continue to keep coming down. A long-term target on oil is $55 a barrel.
David, let's move on to some of the names that you do like. One of those, AT&T. It's actually been off, just about 13% since the start of January. Telecoms haven't exactly been in favor here amongst investors. What do you see as the catalyst for AT&T?
Well, what I like about AT&T right now is I think that stock is at the intersection of being a deep value play, and with as much as growth has run up thus far this year, I still think that the value in the market now is going to be in the value space and communications. And again, the communications sector is the most undervalued sector, in our view, at a 20% discount to fair value. So when I look at AT&T, it's currently rated 5 stars, which is our highest rating, trades at a 36% discount to our $25 fair value. And our fair value estimate, when I look at some of the metrics, that's at 8 times enterprise value to EBITDA, a 7% free cash flow yield. So again, not very stretched multiples, in my mind. I look at the stock, it's paying a 7% or about a 7% dividend yield. And we do think fundamentally the company is in a relatively strong position. We rate the company with a narrow economic moat, which means that we do think they have long-term, structural cost advantages.
What does that moat look like? I mean, when you highlight in your notes that there's only 3 players really when you talk about the wireless space right now. What makes AT&T's moat particularly strong?
Well, there's a couple of things going on here. So one, we do have the merger now between T-Mobile and Sprint with only 3 major players in the market. We do expect that going forward, pricing in the cell phone business and the wireless business should be much more rational going forward. But some of the other things I like here is that, in 2020, they did bring a new CE on, and he's been taking a lot of corporate actions really to unlock shareholder value. So he's been doing a number of things strategically to reposition the business, make sure that they're going to be able to address the ongoing evolution within the telecom sector. But then he's also been refocusing the company strategy. We thought it was a good move to spin off, Warner Media. He also sold a stake in DirecTV. So we do think that, as he's refocusing on that core business, stepping up investments in both the wireless, and the fixed line networks, that CapEx spending will pay off for shareholders over time.
David, you also see some opportunity in a regional bank name, U.S. Bancorp. This comes at a time when many investors are a little bit nervous to touch this sector. Why do you think U.S. Bancorp is better protected amongst some of those risks out there for regionals?
Yeah, I mean, overall, it looks like the regional banks, have been in kind of that bottoming out stage, and this is probably our best pick in the regional area. So it's also rated 5 stars, trades at a 38% discount to our $53 fair value. We do believe that they do have a wide economic moat, and we also believe that the uncertainty there would be more of a medium rating, and again, also pays a 7% dividend yield. So when we think about the regional banking business model overall, yes, it's definitely under stress here in the near term, but it's not broken. And one of the things about U.S. Bank is that they are larger than the typical regional bank, and I suspect that they're going to see less deposit flight. In fact, if you look at the first quarter earnings, I think they only saw 4% of deposits leave, and I think that over time they're just going to have some of the better earnings leverage out there. So when I look at our model, we're looking at for the long term 15% returns on tangible common equity, well above 9% cost of capital, and that puts it in the higher end of our regional bank coverage.
Morningstar Chief U.S. Market Strategist David Sequeira, it's good to have you on today. Appreciate the time.
Oh, thank you.
Well, coming up, we are looking at one possible headwind for the retail sector, the restart of student loan debt payments. That story is coming up.
Curious about what's going on in the housing market and whether or not it's a good time to buy this home or another one? We've got you covered. We've got a jam-packed week filled with experts, including real estate agents from across the country. We'll also get a temperature check on the state of home building and whether or not it's a good time to stack up on those home builder stocks. We've heard from home builders that they're capitalizing on the housing shortage. We'll also tap into commercial real estate. Is it doom and gloom after all? And can't forget, we'll hear from the real estate queen herself, Barbara Corcoran. Tune into Yahoo Finance Live all week long.
Well, the student loan repayment pause is slated to end later this year. With the additional expense further pinching consumer wallets, the road ahead for several retailers is starting to look a bit more hazy now. Joining us to discuss is UBS U.S. Softlines and Luxury Analyst Jay Soul. Jay, always good to have you on the show. It's interesting because you've kind of laid out a profile for those student loan payers or consumers, it sounds like they've got a little bit more loyalty to brands. What is the direct impact you're looking at right now once those repayments start?
Yeah, well, thanks for having me on the show. You know, the student loan payment is a big issue for retailers because when the pause ends, it could be about a $75 billion annual headwind on consumer spending. And, you know, a lot of that spending will probably come, from discretionary items like apparel. The reason that we say that is because student loan borrowers tend to be a little bit younger. They have more professional jobs. They've completed a higher level of education, and they like fashion. And so when they look to pull back on spending to sort of make room in their budget for student loan repayments, it could come from apparel. And what's interesting is that we've already seen that, since inflation has become an issue in the United States over the last, say, 12 to 18 months, these consumers have already been pulling back on apparel. We think they'll continue to do so as the headwinds from student loans, come into play.
Jay, we just had a couple of names from your coverage list that are most at risk. You say because of the pullback that we could see in consumer and discretionary spending here. Of those names, who do you think is going to be hit the hardest?
Well, I would say that it's really about the specialty retailers and the brands. So if we think about these people who have student loans, they're a little bit younger. That's one of the key differences between them and the average U.S. consumer. And, they care about fashion. And so people who care about fashion tend to go to specialty stores. They'll shop directly at brands online. And they tend to not shop as much, say, discounters and department stores. So if we think about mall-based retailers or brands with big online presences, those are the type of retailers and brands who could be impacted by the student loan issue.
Yeah, what do you think the trade-offs are likely to be for those who are buying? I mean, yes, as you point out, they're going to have to start paying down their student loans again. So there is additional sort of income there that they're going to be pinched by. Potential beneficiaries on the other side, you said they don't usually go to some of these discount stores. Could we see potentially a shift?
Well, what's interesting is that when I talk about, maybe relative exposures, that means that, the average consumer maybe shops at a specialty store a little bit more. But these consumers are definitely shopping across all channels. They definitely shop discounters. They definitely shop department stores, maybe just not quite as much as the average consumer. So what we really see is we're going to see pressure across the board on, consensus earnings estimates as, people realize what a big headwind this is. So, we're concerned about the trajectory of softline stocks as we go into the back half of the year. And the student loan issue is one big reason why.
Jay, one of the names within your coverage on holdings you're not worried about, it doesn't seem like the pullback here in discretionary spending on this stock. Your price target's about 50% above the current trading price. What makes On Holdings, why do they have such an advantage in this current environment?
Well, thanks for the question. On is just a great market share story. This is a relatively small brand that has great momentum with consumers. They're really gaining a lot of momentum, not just in the U.S., but also in Asia, in addition to Europe, which, is a European brand. And, what we see is that, consumers continue to adopt this brand at a really high rate. And because it's a relatively small brand, they're not so impacted by macroeconomic forces right now. Their growth is being fueled by market share gain. And we just see that continuing. And that's a big reason that we're bullish on the stock.
Yeah, it's a massive winner so far this year, up 76% year to date. Jay Soul, great to have you. Thanks for joining. All right, well, coming up, we will count you down to the closing bell on Wall Street. We're still looking at gains across the board for the day. You're looking at the Dow up at 50 points. Plus, Brian Sazi sitting down for a one-on-one interview with the firm founder and CEO, Max Levchin. You won't want to miss that.
What we have is a merger between PGA Tour and Live Golf. The Saudi Public Investment Fund will be bankrolling a large portion of that new league to create sort of this big giant golf conglomerate. You can see golf stocks today have actually popped on this. Callaway golf stock up about 5% on this news. It seems like the market overall for golf stocks is bullish on this for the industry.
We need to see ultimately the reaction, how this plays out, but I'd call this, just as a huge golf fan, an absolute shocker.
It is hypocrisy. On the Live side, to your point, it was all about, well, we're offering competition here. There's only been one entity. And then on the PGA side, it was about the Saudis. It was about the 9/11 families. It was about, we would never go near that. At the end of the day, it's business.
To apply it to markets, we are seeing that there is a smaller and smaller handful of companies that are gobbling up everything.
I was as shocked as the rest of the world yesterday. I still have to say I don't fully understand either the process by which this happened or the premise of it, especially given that the tours were already under a bit of regulatory scrutiny for antitrust related issues. This seems to only potentially exacerbate that.
From a business perspective, this was kind of always how the story was going to end as long as Saudi Arabia stayed interested. You cannot compete with an entity with limitless resources and expect to come out on top if your measurement is by dollars and cents.
This was all about money. I don't think it ever was anything else. PGA was put in a pretty bad spot. Maybe they put themselves in that bad spot. They couldn't afford the lawsuits. They couldn't afford the growing purses. And unfortunately, to some extent, they were in a position where they had very little option but to do this merger.
This PGA merger, it's designed not only to diversify Saudi Arabia's economic holdings, but also to help its image internationally. And that's also important to Saudi Arabia.
Counting down the final seconds of the trading week, all three of the major averages heading higher for the day and also for the week. The Dow up 45 points here, S&P up just about 0.1%, just shy of 4,300 there. And the Nasdaq up about 0.1%. The Nasdaq on track for its 7th weekly gain in a row. The Dow hitting the highest level that we have seen since the beginning of May, and S&P highest since August. Well, there's the closing bell again. All three of the major averages ending in the green, ending to the upside today. Let's take a look at some of those individual movers. First up, Tesla shares edging higher, locking in its 11th straight day of gains. Now, this ties its longest win streak ever, which took place back in January of 2021. The rally in Tesla coming from a pileup of good news here. The latest headline being its EV charging partnership with GM Kiko, adding to the momentum that we saw last week following the announcement with Ford. Seems like it's good news here for Tesla.
Yeah, I mean, there's the expectation now that they've got this partnership with GM, in addition to Ford, that this NACS, which is the charging port that Tesla uses, that could become the new standard here in North America, at least. What's interesting to me, as we've been saying, is just sort of how the other EV charging companies have gotten hit on the back of this, but it certainly feels like it's a big win all around, not just for Tesla, but for adoption of EVs. All right, Netflix posting gains on a report. The streaming giant saw U.S. signups rise by the most in at least 4.5 years. This boost in user acquisition coming in days after Netflix's crackdown on password sharing last month. The data, of course, coming from analytics platform Antenna. It is a good sign, of course, at a time when investors were concerned about, how much churn we'd likely see as a result of the password crackdown.
Yeah, and the big question, you brought this up earlier, is whether or not the type of gains that we have seen, maybe not to the degree, but how much of that momentum is going to continue. Obviously, when we saw the crackdown here in the U.S. of the password sharing, many of those users who were affected did sign up right away for new accounts. The question going forward is just how much runway Netflix has, but shares hitting the highest level that we have seen since February of 2022. The Street very positive, though, on this move from Netflix. Pivotal was out with a new note today, just calling this a unique tech growth story here. And I think that's what a lot of people are just trying to figure out when we look at the 2-year chart of shares still under pressure, off just over 13%, what that subscriber growth looks like here going forward, given the fact that there is some saturation here in the U.S. All right, Affirm shares closing the week up just about 10%, driven on news of a new deal with Amazon. Yahoo Finance executive editor Brian Sozzi spoke with Affirm founder and CEO Max Levchin earlier today about that new agreement.
Very important. We're building a network, and networks are fundamentally about being ubiquitous, being available to consumers wherever they want to shop. Obviously, we're big believers in the dominance of digital wallets. I read somewhere that by 2025, half of e-commerce will be conducted through digital wallets of some kind, and being embedded in one of the most important ones, Amazon Pay, is really, really crucial for us. So we have 16 million consumers that already use Affirm all over the place. Finding their favorite credit card alternative inside Amazon Pay is going to be a good thing.
Now, if I'm right, you already had a deal with Amazon. You inked that a little while ago. I remember it was a big event and a big moment for you and your company. What are some of the observations from that deal that you have found?
You know, very happy with the relationship. They've been a great partner to us, and I'd like to believe that we have absolutely done all the right things so far. Obviously, the big difference between Amazon Pay and Amazon proper vis-a-vis Affirm relationship is this expands the coverage to all the merchants outside of Amazon.com that use Amazon Pay. They can choose to offer Affirm. But even within Amazon.com, we've seen extraordinary acceptance by consumers. You can actually see our payment rating. Amazon rates everything. They love ratings, and we are one of the highest rated payment methods that is available on Amazon, which we're very, very proud about. We share great commitments to consumer satisfaction, and that's a good measure of it.
The vibe on Wall Street, Max, seems to be that this is good for your GMV, or gross merchandise volume, but maybe not that big of an earnings lift. Can you debunk that?
You know, never a good idea to go deep into any one particular deal, especially as multifaceted as the relationship we have with Amazon. But fundamentally, networks are powerful because they have what's called network effects. The more available we are, the more likely we are to be selected by consumers and by merchants. In this case, far more importantly, repeat transactions become much less expensive to underwrite, much more profitable through reduced losses. So in the long term, the network accretes to its value through broader distribution. And so this is a very, very important deal for us. We're very excited about it.
Does it help you reach, let me ask it another way. Are you still on track to hit your profit goals for this year?
We're doing well. You know, we got, 20 days left in the fiscal year for us. I think we feel quite good about how we're doing towards all the promises we made.
Good to hear. I know it's been a long road, and part of that road is standing up other products. So I believe you've also launched, a new debit card or debit plus. How is that going?
That's right. You know, it's been a long time coming. That's a product that we spent a lot of time getting right. We pulled back on a launch about a year ago, and we thought it was not quite ready. We finally felt really good about it about a half a year ago, and we're really rolling it out now. It's an amazing product. I'm very, very proud of the team that built this and did not settle for a half-baked product. It's an extraordinary product. It's a debit card that connects to your existing bank account, and at any time we need borrowing capacity over and above what your personal cash flow allows you to do, you can just supernaturally, using the Affirm app, turn a transaction into a loan before or after you swipe the card. It is nothing short of miraculous, and we're seeing excellent adoption with our existing user base. We're offering it today predominantly to existing Affirm customers, of which we have millions and millions of, so there's no marketing cost. And from day zero, it's got great, very strongly positive unit economics. It significantly improves frequency of transactions. I think in the last earnings call, I said it's about 7 times more active in the first 3 months as any new Affirm consumer. And so on and on. It's just a great product. Very proud of it.
An important product for Affirm, definitely, but it comes against a backdrop of a consumer. It's weird. They're weird. So they're out there spending a lot on services. They're taking vacations, but they're not necessarily in the stores buying stuff, furniture, apparel. What's your read on the consumer as we get into those crucial periods of back to school and then eventually the holidays?
You know, I think consumer is still well employed. The U.S. economy is performing a lot better, a lot more resiliently than I think some of the naysayers had said 6 months ago, 9 months ago. That said, I think nothing's really off the table in terms of, is there going to be a recession? Is there not going to be a recession until we find out what happens with the student loan repayment restarts sometime in the fall. And so I think a lot of folks are mindful of that. They're cautious. They are also suffering, understandably, from inflationary pressures on commodity prices, services prices, travel prices. They are getting out of town. Vacations are growing. Travel and ticketing is a huge segment for us. Last quarter, we bragged about enormous growth in that segment relative to obviously pandemic lows, but even a year after the pandemic started to wither, it's still growing really well. There's plenty of pullback in things like electronics, homewares, things that you may have purchased significantly more during the time when we're all cooped up in our homes and trying to turn them into gyms or offices. And so that all of that is, generally speaking, as predicted, going really well, seeing growth in places, seeing retraction in other places. The real question is what happens to the economy once the student loans come back, and what does the Fed do about it? We're prepared for both eventualities. You saw we printed another extraordinary quarter of credit management or credit results last quarter. Job number one at a firm always is making sure our consumers are able to pay the bills to the loans that we make them. We do not make loans unless we know we're going to get paid back.
Do you see the student loan repayment, by some estimates, that might pull $400 to $500, if not more, per person out of the economy each month? Is that a headwind to your business, or is that actually a tailwind because people may not have that cash and they come and use services like a firm?
Exactly. And the completely honest answer is it's an opportunity, but it's also a thing to watch. We do not want to overextend our consumers. We don't charge late fees. We don't compound interest into interest. We are the honest financial product, which means that we can only lend money when we know the consumer is capable and willing to pay us back. As they feel the pressure of student loan repayment or starting, they will need more access to capital. That's our job. That's what we'll be there to do, just like we were there for them when the inflation started to hit them hard. That said, if they get to a place where they can no longer afford the money they want to borrow, we will be obliged to tell them no. And as we have, and we've been always honest with all of our consumers. So we feel very confident about our ability to manage the credit of our borrowers. But I think for some, it will be a happy need to use a firm, and we'll be there for them. And for others, it'll be a real strain.
Max, since we last spoke to you, there's just been an explosion in AI. It's come out of, I wouldn't say nowhere, because these projects have been working on, but really over the past 4 or 5 months, companies like an NVIDIA, an AMD, a Salesforce, they have just done or starting to do even more mind-blowing things. As a veteran in tech, is this just a moment in time, or are we sitting on something very generational here in generative AI?
So, not to make too much light of it, but we've been using AI in a traditional sense of the word, machine learning, and the earlier versions of it for over a decade, and it was never that big of a deal until the moment we're having now. Generative AI is a new thing. It's a profound new technological. It's not really a discovery. It's been around for quite some time, but the current breakthroughs really are breakthroughs, and we are using it today quite successfully in both developer productivity and very, very carefully in customer service and consumer servicing. And the reason we're so careful, there's always a human involved in overseeing generative AI results, because we have not yet solved the hallucination problem. If AI advises you to do something very bad for you financially, personally, it's going to break someone's wallet and potentially create some real pressures on that consumer. Can't have that. So we have human in the loop for all of our generative AI exercises, but it's really exciting what you can do with it. I think the computer or machine co-pilot for human financial decisions is a powerful construct, and we're excited to be there with that.
What are some of your reservations or concerns about AI as it infiltrates, or this generation of AI as it infiltrates into the economy and corporations, you name it?
I'm not concerned about the job destruction, which I think there's plenty of naysayers are sort of warning us all about how it's going to come and take your job. I think humans are going to be quite important in a lot of intellectual work for quite some time, and AI is going to be a great tool. It's a productivity enhancer, not a job eliminator. I do worry that we will find ourselves placing too much trust on systems that are not yet fully proofed for safety. The number one worry I have about AI is not AI infiltrates some important computer system and turns us all into paperclips. It's that some person asks a chatbot, hey, give me some code that I can cut and paste into a compiler or an interpreter. And that code is faulty and actually causes real problems. And so inadvertent, foolish errors are much more dangerous today with AI of today's generation than any sort of a maliciousness or evil AI overlords.
Our thanks to Affirm founder and CEO Max Levchin and Yahoo Finance's Brian Sazi.
Well, it's closing time here on Yahoo Finance. Here's a look at some of the key things to watch next week. All eyes will be on the Federal Reserve. We're going to be getting the FOMC decision on Wednesday. Markets are betting on a pause at this meeting, but many believe there could be further rate hikes down the line as early as July. In recent speeches, Fed officials have been split on whether the central bank should continue on its path of rising rates.
On top of the Fed decision, it's a busy week on the economic calendar. We will be getting the latest readings on inflation, both the consumer and producer price indexes. Other checks on the consumer are due as well. Both retail sales and consumer sentiment will be released.
And on the corporate calendar, it's a bit of a slow week for earnings, but we will hear from software giants Oracle and Adobe ahead of the report. Oracle shares hit an all-time high on Friday. Analysts will be watching to see what the companies say, of course, on artificial intelligence. Also, home builder Lennar and grocery giant Kroger are set to report.
Well, that'll do it for us today on Yahoo Finance. Be sure to come back Monday, 3 p.m. Eastern Time. Got your coverage leading up to and after the closing bell. Have a great weekend.